Thank you. Glad that everyone is here, and we're going to be offering time for Q&A throughout the time. And Thomas is on, and he's going to be taking those questions. So there is a chat box, but if you guys will make sure you ask questions in the Q&A box, so that way we don't accidentally have one of those get lost. So it's a lot easier to organize those. So if you see the Q&A box that's right next to the chat, it'll allow us to answer your questions accordingly. All right, so we're going to get started. Joe, you ready?
Yes, sir. Let's do it.
All right, perfect. All right, welcome. This is our part 4 of our Financial Freedom Live course. So far, we have covered cash flow, which is our first step in our 4-step process. In that, we went through the automated budget with Eric, which was amazing. Most of the people who've gone through that course have just continued to give us great feedback. Eric offered an opportunity for people to do a boot camp with him during that. I know some have taken advantage of that. So if you're looking to get involved in that, make sure you go and sign up for that opportunity. Step 2, we went through debt and how to pay down debt efficiently and to get our arms around maybe the practical, emotional, and philosophical ways to paying off debt. And then last week, in part 3, we went through taxes and really hit on some interesting things there, Joey. What were some of your takeaways from step 1, 2, and 3 in the cash flow area?
For me?
Yes, for you, not for other people who are not going to be able to respond to me live.
I would say number 1, from a budget standpoint, having something that's easy to follow and automate was critical. And I keep hearing people say, wow, this is something I can actually follow. It wasn't this, you have to be an accountant to actually keep up with it type of thing. And then the other big takeaway that I've gotten from it is last week, I think people had a lot of questions, or at least as we've talked to people about infinite banking, one of the very first things that they say is, what can I do with my 401k? What can I do with these qualified plans? And I think hearing Todd's group give some clarity and some definition around the CARES Act and what that allows, that is that's a more immediate thing as it pertains to taxes, but it is certainly something that's critical for people to gain control of their finances and then to begin their opportunity fund, which is kind of what we're talking about today.
Yeah, no, I love it. I think when you have cash flow, you have to have a place to put it. And so that's what we're going to be focusing on today in the infinite banking concept. If you've ever heard of infinite banking, tell me yes, please, in the chat. Give me some idea of how many people have actually heard about it, maybe even read Nelson Nash's book, Becoming Your Own Banker, maybe watched IBC 101 in the community, maybe heard us talk about it on a podcast or someone else's podcast. All right, perfect. Thank you. That helps me make sure that as we go through this, today's purpose is to kind of hit the high points of what infinite banking is. We do have an all thing IBC group that's inside the community, and that's where we dive deeper into more applicable situations. It's where we answer our clients' questions and people who are coming in who are using this to go deeper. But today we want to hit the high points just for some of you who may still not be doing it and are wondering why there's so many people talking about using cash value life insurance as a savings tool. All right, Joey, since you're the one that has the writing mechanism, if it's all right, I'm going to let you take control of this and we'll just bounce back and forth. Is that good?
Yeah, let's do it.
All right, perfect.
I'll share my
Thanks,
screen.
everybody, for giving us feedback. That's good.
All right. So we kind of were talking about really the end where we're all headed with this. And forgive us if you're tired of hearing the same thing over and over, but I think it really is what we're all on the journey to. And infinite banking can only be explained within the larger context of where we're headed, right? And we have talked about this everywhere, but PI greater than ME is just short for passive income, must be greater than monthly expenses. That's the only point at which you have choices. Until then, your choice is to go to work in order to provide, to have active income, to cover your expenses. Otherwise, you're going bankrupt, right? So, in light of this financial formula, the infinite banking policy and concept is going to assist you along the way. It's not the end, it's the means. Okay. What do you want to add to that, Russ?
No, yeah, no. So this is the end. What you just showed up there. This is the end. This is where we're going. We're going to a point of financial freedom. When you entered our community, you answered the question, "What does financial freedom look like for you?" And many of you have visualized that through time, through travel, spending more time with family, and maybe it was things that you were going to purchase or people you're going to help with it. And that's the visual. There's where we're going. So when we talk about infinite banking as it plays a part in this process, it's really helping us determine where are we going to store our cash. And I love this example because the author of Becoming Your Own Banker is a man that Joey and I got to know quite well. We happened to live in the same city with him. We would eat lunch with him quite frequently and had a handful of dinners with him over time. And one of the most common things that I would hear Nelson Nash talk about is banking is. He would repeat it over and over that your money has to reside somewhere and someone is going to perform the banking function. Meaning if I want to buy something, my money has to come from one account and transfer to an account to you very quickly. Otherwise, the whole deal's off. And he said, somebody's going to perform that function. And the banks, the financial institutions that we know that are around us all over the place are doing quite well off performing that function for you and I on a daily basis. And so he would just say, do you want to perform that function? Do you want to be the one who controls and earns the profits of that enterprise throughout your lifetime? And clearly we all can think about the amount of money that has run through our hands and will run through our hands in the future. And if we run it through option A, which we always like to refer to as just a savings account, checking account. Now we are going to have checking accounts. So this is not to say we can ever eliminate a checking account, but Nelson Nash would say that a bank in its purest function is taking savings dollars and turning those dollars and lending them. And a checking account, when money's just coming in and out constantly, is not what they're in business to do, right? So we refer to this as a savings account because that's where we would put dollars and may not use them immediately. So that option A, savings account, is where most of America runs their dollars through for major purchases. And so when we look at what is it that we can have and what is it that we want, we want access to our money, right, Joey?
That's right. I'm going to write these down, these different characteristics.
We want access to our money. That's the liquidity of it. We want it to be safe. I mean, especially in times like this, right? When we're seeing accounts drop 10, 20, 30, 40% in some situations. We want it to grow. And lastly, we want it to be protected. And protected from who? Protected from the government, protected from loss, protected from creditors. I mean, all of those things would fall into protection. And we want to make sure that we have it safe. So as we look at a place that we could store cash, a savings account, then we would say, yeah, I'd say there's got accessibility. I'd say it's safe. I wouldn't necessarily it has competitive growth, right? And if it did grow at any shape or form, it would be subject to taxes.
Right.
So a savings account would give us two of these four characteristics. But because it's so common, most of us do it. And so Nelson, one of the things he would share a lot of times with us, he would give the example of a Walmart distribution center. Tell me in the chat, do you know what a Walmart distribution center is? Because when he asked me this question, I didn't even know what it was. And he would pull up a Google map and he would show us one where we live in Birmingham, Alabama. He would go just north of Birmingham, and in an area called Coleman, there would be this large building with hundreds of 18-wheeler trailers surrounding it. And he'd say, Russ, that is the hub of what the Walmart stores you see and you go and buy and shop from. That is the hub right there. All the goods goes to that one distribution center, and then they turn around and they send those goods to the retail stores who sell them for a profit and turn those dollars and send it back to the distribution center, who then takes those dollars, buys more goods, and they repeat the process over and over and over. And he goes, Russ, where is your hub? And he was getting me to think of, where is my hub? Where is the warehouse? Where is the place in which I'm going to store cash? Because he was making the point that the distribution center didn't sell anything except to its retail to its retail stores. A customer doesn't ever show up at the distribution center and buy something. And so he's saying the investment, the return comes at the retail center. That's the place in which the dollar is deployed. But those dollars always come back to the distribution center and then repeat the process over and over. So for us, we would show this example of a savings account as option A and say, is that the best hub for our money? Now, we know that we can possibly have access to it. It can be safe, but it's not going to be necessarily the best hub. And so the other option, and he's the one that showed me this. I don't know if any of you guys know my story, but I started in the financial industry in 2004. I became a certified financial planner in 2008. Great timing, I know, the time in which the whole market turns on its head and everything that I thought I knew turned out to be wrong. But I was an investment manager. Now I refer to those kind of people as money babysitters. So I was really a money babysitter. And I got paid well as a money babysitter. But my goal was not to use things like this, places where people could put their money and then turn around and use it. I was the one wanting them to just give it to me and let me hold on to it. And so Nelson Nash showed us this tool, a dividend paying whole life policy. You can just write that DPWL if you want to, Joey, dividend paying whole life policy. And in all my training, I had learned that this was one of the worst places anybody could put money, because it earned 3 or 4%. It took, 20, 25 years to have any real cash in it. And, maybe my grandfather owned one when he was a younger guy. Maybe someone who is super risk averse may buy one, but there would be no reason for somebody like me to have one. And that's when he started sharing these conversations with me. And Joey, I think you have a slide that we share quite frequently, and you may just want to draw it out. But he said, Russ, do you know who the largest owners of these dividend paying whole life policies are? I said, I have no clue. He said, well, I'll give you a little bit of a clue. The name is in my book, Becoming Your Own Bankers. He said, Russ, banks are the largest purchasers and owners of whole life insurance. And he proceeded to take me to FDIC.gov, went and did an institutional directory, pulled up Bank of America as an example, and said, look here. Look, this is their balance sheet. Look how much money Bank of America owns in permanent life insurance. It was $21 billion. He says they have a standing order to buy as much of this as they possibly can on their executives, as the government will allow them to do, because there's actually a limit to how much money the banks can own. And that bank-owned life insurance called BOLI. I guess my numbers are off a little bit now. That's 22 billion.
Russ, come on. Let's get it right.
Used to be 21. It's gone up. I told you they're continuing to buy as much as they possibly can. And that's called Tier 1 capital. That's your safest capital. And he would ask the question, why do you think banks own this stuff? Well, why do you think? Well, because it's a safe place for them to store cash before they deploy it. So what is it that we're looking for our cash to do, Joey? We said we gave it 4 jobs. We wanted it to be accessible. We wanted it to have safety. We wanted it to grow. We wanted it to be tax-free. And he said that's exactly the way a dividend-paying life insurance policy, if it's designed properly, will do all four of those things.
Hey,
Now,
one thing I want to add in here, Russ. So people often ask us on the front end, and how's my audio, by the way? Am I okay?
you're good.
Okay. Um, People often ask us, well, how does this compare to my 401k or to a SEP IRA, or I've been doing this 403b at work, or fill in the blank, any sort of like qualified plan by the government? How does this compare? And I think the first thing you and I both would say is, number one, it doesn't. It's apples and oranges, because do you ever think about when you're putting in money in a 401k of it being savings or investing? And we have to simplify it to that level, because I think people will try to compare this to something it's not intended to compare to. The investment, in fact, I think you have a story about like even what Nelson used to call the garage or whatever. Like, why don't you tell the story? I'm going to butcher it.
Well, I'm glad that you let everybody know that you were going to butcher it, because that was absolutely the truth. Well, I think saying the same thing three different ways, sometimes these stories help me, because early on he'd give me one example, and Nelson was a lot uh, like Jesus, in the fact that Jesus was asked questions and never gave a response. He would always ask questions and then talk in parables. And I felt like talking to Nelson was a lot like that. He would give us lots of different examples, and he would want you to think through it. He would say these things are not things that can be uh, taught, but they have to be caught. And so he gave me another example that really resonated with me. He said, "Russ, do you have a garage?" And I said, "Absolutely." He said, "Is it clean enough to park your car in it?" I said, "Well, at least one of the two cars can fit in it." He said, "Well, let me ask you, when you want to go make money, what do you have to do?" "Oh, I have to go get my car and I drive to work." He goes, "Exactly." And that's the way everybody is, right? They're going to go somewhere, to a business, or to do a deal so that they can make money. But once you've made the money, do you typically come home at the end of the day? I said, "Yeah, I prefer to." And he said, "All right. And where do you park that car? Do you park it out in a driveway, so it's out in the open for all the elements, or do you park it in the garage so it's protected?" Well, of course he knew the answer, and he's just poking at me, and he was just saying, Russ, this life insurance policy you're using for your clients, because I know you're kind of an investment minded person. You're thinking about businesses, you're thinking about real estate, you're getting excited about the opportunity of this Amazon business, or this mobile home park, or you fill in the blank investment. He said, that's what you get in the car to go do. He said, but when you come back, it's got to go to somewhere and be protected until you go back out again. And that's where we reside. That's the garage. That's what we're going to look at this life insurance policy as the example, as the garage. So I think we hopefully have hit the point for you to see that in our 4-step process. First step is getting access to our cash flow. Step 2 is having a safe place that is liquid, that is protected, that's going to have some growth, but it's not intended to be the end investment. That's where this life insurance policy comes into play. Now, let's move on just a step here, though, Joy, because I want to talk a little bit about what is it that this does, because ultimately we got to compare it to something, right? So a lot of times people say, okay, but I don't understand. I know there's expenses with this life insurance policy. I've heard you guys talk about the word loan, and sometimes that becomes a big hindrance, because we've been trained to get out of debt, and we just went through in step 1, we talked about how to get out of debt. And so the concept of borrowing money from an insurance company sometimes can rub us the wrong way. So let's talk a little bit about in concert of how we're going to use these policies, and how does that work, right? So if we're going to compare it to paying cash for something versus using an insurance policy, I love to give this example. And if you've gone through IBC 101, you've seen us kind of talk about this as kind of the saver, spender, and wealth creator.
All right. All right. So you want me to take it from here, Russ? Or you
I want
got
you
it?
to try.
Oh. Okay. So again, we don't want to just completely repeat everything that you've already read or seen. So if you have questions about this, put them in the Q&A so we can make sure we address them as we go and even have some time at the end as well. But in terms of how is this different than any savings vehicle you've ever had? First of all, we have to compare it to, first of all, people that are, there's three
Joey,
different
can you
types.
speak up a little bit? Your volume's pretty low.
Is it? Okay. All right. I just have to hold the mic closer.
There you go. Thank you.
Okay, sorry. So first of all, we have to compare it to how the three different types of people that there are. The first is the person that spends first. They don't actually save up for anything. They purchase the money on credit or some other sort of loan, and then they proceed to pay that back with cash flow, right? And ultimately they get to zero. And usually they bought some sort of depreciating asset, something tears up, and they have to do it all over again, right? So they borrow again. And what's that person doing? They're getting immediate satisfaction for whatever it is that they want, but they are having to do that at a cost, right? The cost is interest. And most people that have learned anything from any financial books or gurus or what have you, they would say, okay, well, this is worse than somebody. I'm not like that person. Like, I don't go into debt. I always pay cash for everything. And so that's going to be our saver, right? The saver is the person that instead of taking a loan and buying that immediately, they go ahead and start saving that cash aside so that they don't have the interest expense. But then what happens is they have to dump that money out of their bank account in order to trade it for whatever that good or service is that they were saving for. Now, they've done that so that they can save this interest. But ultimately, where do they end up? And the point that we'll make here is that both are heading towards zero. Now, one is actually saving a little bit of interest, but don't they both end up mirroring each other? And we talk about this point where we're chasing zero. Now, the difference is the third person, and that's going to be the person who is compounding on their money. And this is the thing that I've never had anybody disagree with me yet. And that's, if I could compound on my money, would I want to do that? And for how long? And when would we have wanted to start this? It would have been 20 years ago, right? Because compounding interest is all about time in the vehicle that is paying interest. True or false? 100% true, right? And what happens in a savings account is that we're forced at whatever time frame that we need access to the capital. And I'll just use this as the example, the top of the stair steps here. We are forced to take I'll use the example of a cup. I've been filling up a cup this whole time, and then I finally get the chance to go and use that money. And what happens? I have to dump it out. That means I have quite literally stopped the growth of whatever that account is. Now, you may be thinking, I'm in a savings account, it's earning me 0.01%. What have I really given up? And you'd be right? The standard savings account in America right now is pathetic. It's a joke. But if we compare that to how these policies work, is that they have the ability to compound, and this is what a compound interest curve looks like, right? This is where I was talking about time. Time has to take place in order for compounding to happen. But if we kind of look above and we say, well, let's see where the savings account stopped compounding. Well, it stopped here, right? And then it started again, and then it stopped here. And then it started again. And each time it's kind of starting, and it's starting, and it's starting, and it's constantly going like this. Every time we dump that money out, it has to start over. Now, think about your car. As you are looking at cars, maybe you have recently bought one and you had to go shopping for them, and you look on the side of the car, there's two numbers, right? One, well, actually, there's three numbers. One is the price. The other two have to do with miles per gallon. Now, why is there two different ones? The first one has to do with city miles. The other one is highway miles. And one is more of a continuous motion, and one is a start and a stop, start and a stop. Obviously, the one that's the start and the stop, the city miles are less efficient. So they're going to be less miles per gallon. This is the same thing that happens with our money, but I just want to kind of make a correlation there. Now, this is a picture of what we would call the difference when you've started that and you stopped it and then you've given it less time to grow, you have given up opportunity cost. Okay. Now, opportunity cost is the most expensive thing that you've never been billed for. Okay. Think about that for a second. If I've been paying cash for everything in my lifetime, how many dollars have flown or gone through my fingers, or the banking institution that I've used the functionality of banking, how many dollars have flown through that bank that I get zero growth from? Think about that. That's an enormous number. I don't care if you're in your 20s or your 70s, it is a large number. And the opportunity is the difference of what I could have earned had that money been compounding the whole entire time of my lifetime. Now, that's the other piece of this. Whole life insurance is exactly that. It is growing my entire life, not for just one piece or one portion, my entire life. And the opportunity on that is enormous. Russ, anything you want to add to that?
Well, the question that we like to ask, and it was asked of me, was when would you ever want to stop compounding interest on your money?
Never.
Never. But yet the way that we have, the places that we have stored our cash before we went out and deployed it, before we took it out of the garage and went to work with it, before we left our distribution center in order to go sell it in our retail businesses, is that we had to stop the compounding interest on our money. And I love the way you said that, Joey. Opportunity cost is the most expensive thing that you've never been billed for. That's going in the book, man. That's a quotable item there.
I'm thinking I want it
That's
at least on
money.
a t-shirt somewhere, you know?
That's money. I love that.
Okay.
Well, and so when we talk about these dividend paying whole life insurance policies, they have all the characteristics of a really safe place for us to put our money. But one of the things that is always hard for us to get over is the function of borrowing, right? To take our capital. So let's visually help people see that compounding interest effect through using the insurance company's capital that they're only giving us access to because what? We've put money in it. And
That's
I
right.
think that's a part that is sometimes overlooked, because sometimes people say, well, if I'm borrowing money from the insurance company, I'm going into debt. Well, we cannot be going into debt at the insurance company. They will not allow it, meaning that they will only give us a loan against the cash value that we have built up. So we never can go below zero. So we're always going to stay above the zero line. But how does that compare to that curve that you were talking about there, Joey? Let's show that. Show me what it looks like if I'm growing my capital in this business for my whole life. That's a great the way they describe that these policies should be for our whole lives, and for some of us that's 10 years, for some of us that's 70 years, and none of us are smart enough to know that. But we're growing this cash for our whole life, and over that time frame, when we do it, we've got to use money. So you do a great job of explaining that. So share it.
Okay, so this was the thing that Russ shared with me about 10 years ago, and he had to share it with me several times. As you may have heard me on the podcast or otherwise, you know I'm not the smartest or the sharpest tool in the shed, and I have to hear things a few times for them to sink in. In fact, I ask the same question sometimes multiple times because I can't even remember what he said the last time. But I just happened to be sitting with him, and one time he showed me this diagram, and it just obliterated everything. It finally clicked. Okay. So as we are putting premiums into a policy, this is what's happening. So I've got my policy. It is significant. It's consistently growing a cash value associated with those premiums. Now, in the first couple years, I'm putting in $1 and I don't have access to 100% of those dollars, but I have access to a large percentage of it, which becomes my cash value. Okay. Now, rather than get into those details at this point, I'm just going to I'm going to assign a value to what the cash value has become. This could be happening. Now, we have clients that have put money in policies that have more than this day one, and some people will take them 10 plus years to get this. Okay. But we're just talking about, let's just say that it's accumulated $100,000 worth of cash value. Okay. Now, that is my policy that I have control over. And as I pay premiums, that is the point that's a unilateral contract with me and the insurance company. I pay them premiums. They are required then to hold up their end of the bargain, which is to, one, provide a death benefit, and to also give me access to the cash value as it's accumulating with a guaranteed growth schedule. Number one. Okay. And you can look this up under the 7702, the IRS code 7702, as to why these are guaranteed. In other words, the IRS will only allow an insurance policy to be created under these tax exempt, or in this case, tax deferred, and then subsequently tax free access to capital, if they meet the requirements of the 7702. And so this is why we have guaranteed growth within insurance companies. They have to do it. They have to comply with this in order to offer this to us. Okay, so this is huge. This is not based off of the market, which today means more than anything. It's not based off of how good Joey or Russ are at managing money, because this is 100% on the back of the insurance company. And that should give you a whole lot of solace there. So they're going to provide us a death benefit that's guaranteed, and they're going to give us access to the capital in the way of cash value. Now, let's say that you have to purchase a car, you want to buy into an investment property. Let's say you want to start land flipping. Let's say you want to start an Amazon business. It takes capital to do that, right? So let's say that you need $25,000 for whatever reason. Okay, just simple numbers here. Instead of taking the $25,000 out of my policy, which is, by the way, I'm going to revert back to this. The only way to access money from my savings account is to do what? Is to remove the money from my account that was earning any interest. That's this picture right here, right? I had to remove it. But if I go down here, the way that I can access the cash values of a policy are, I don't have to withdraw it. Now I can, but what I'm going to choose is I want my money to stay on this trajectory. Well, how is that possible? How does an insurance policy allow me to have my money grow on that trajectory? The only way it does is if I can collateralize my money and use someone else's money in the meantime. So who's that other person? It's the insurance company. Okay. The insurance company has their pool of funds that have been allocated first to me. As a mutual owner of the company, they want to lend against my policy before they do anything else, because it's 100% backed by their own death benefit that they have guaranteed to me and my heirs. That's huge. Okay. So I almost have first right of refusal if you think about it. So I'm going to take, instead of the 25,000 coming from my account, they're going to utilize $25,000 of my cash value as collateral. Okay. Those brackets, that's a really fancy way of saying collateralized. And they're going to subsequently send me the $25,000. Now, this is where my artistic abilities come in. So they send me the 25,000. Now I can come over here and I can do whatever it is that I want to do. I'm going to just go in here and just say an Amazon business. Okay. So I use those funds to create cash flow. Those dollars come back to me. And subsequently, I'm going to pay back the insurance company those dollars. Now they're going to be paid back at a 5% rate. I'm borrowing the insurance company's money at 5% so that the 100,000 that is in my policy continues to grow uninterrupted. Now, that is the power. Now, if we're talking about year 1, year 2, year 3, those dollars uninterrupted, hey, really doesn't make that big a difference. In fact, if I took every dollar out and I borrowed it, and I shouldn't say out, if I borrowed against every dollar of my cash value all the time, would I get ahead? No. This is not about like trying to find some loophole and not have good accounting practices. You can't get rich off of using every dollar all the time unless there's some way to create arbitrage, so to speak.
All right, Joe, can I jump in here?
Please.
Your artistic ability is getting worse by the minute, and
Thank you.
but I want to bring numbers to this example. Is that
Okay.
okay?
Sure.
All right, would you quit sharing your screen for just a second? I'm gonna share mine.
Got it.
So I'm gonna jump in here because I love to just again speak from experience, right? Because this is one of the things that Joey and I in our business we always talk about is practice what we preach. And so when I started this, I mentioned I learned about all this stuff in January 2009. I'm a slow learner, so it took me a while. So the first whole life policy I bought on myself was in January of 2010. You can see that on this issue date here. That's right. I know I look a lot younger than 43. So I know I've shocked you guys. You guys see my date of birth there. But if anybody wants to send me a birthday present, either late or early one next year, I'm always willing to accept those. But this is a policy I started 10 years ago. And I got the statement in the mail, and just what Joey was talking about is how does this really work? And I'm going to focus on just a couple of numbers here, and not get too caught in the weeds. But you can see, obviously, we use these policies. You can see this outstanding loan balance here. This is a policy loan that I had at the time of January. I've subsequently actually paid that back. I took a home equity line of credit at 1.9% and paid that off just recently. So we could talk about it on a different episode why I did that. But one of the things I love is just kind of getting to see how these policies are performing. So Joey's saying is that we put dollars in these accounts for the purpose of using those dollars to create cash flow and create actual other assets that produce passive income, because we're on the same journey you are. We're trying to get to where our passive income is greater than our monthly expenses. So that's what these dollars have been out there doing. And along the way, the premiums that I was putting in this policy are actually growing too. He just showed the example of his $100,000 was earning interest. In addition to what he took the $25,000 out and created cash flow, it was doing something too. So it's doing two jobs at once, and sometimes 5 or 6 jobs, depends on what we use the money for. So here's a policy. I started it 10 years ago. When I started the policy, I could put in $25,000 a year. Now, I didn't know quite what I know today. And so I didn't have it all set up to where I could keep putting in $25,000 for as long as possible. I had it set up where I could only put it in for a couple of years. And after the 6th year, my premium dropped from $25,000 a year to only being $7,195. You can see that right here. Now, for some people, they're like, oh, that's good, right? Because they see their insurance policy as an expense. But when you see it as collateral, right? If you have a business, you know, you've never had too much money in your business, right? There's never been a business that's been over collateralized, had too much capital. Had too much capital in it. And so everybody wants capital in their business. We always want money. And so, but initially not understanding how these work, I had it set up to where I could only put in 25,000 for about 6 years, and then it dropped down to the smaller number. Well, why is that a problem? Well, if you look over here to the right, you can see what was my past year's cash value increase in comparison to what I did with the cash. So I put in $71.95 as a capital contribution, as a premium, is what the insurance companies call it. And in return for that $71.95, I got $2. I got $14,802. So now you see I have $110,000 loaned out. So I'm using the money. That money is in all types of investments. Some doing really great, some not so great, right? I mean, you've heard us talk about some of those investments on the podcast. But at the same time, of investments that I could buy, because I set this policy up 10 years ago, I can go buy $2 worth of goods and investments instead of one. Because if I was putting this amount of money in my savings account, how much could I take out this year? The same number. Maybe it would be, maybe they would have given me $6. You know, I don't know what the number is. It's something really, really small. It wouldn't have been that much money,
Right.
especially if I had taken the money out and used it to do something else. It wasn't like it had $100,000 in it because I've already used it. But in this situation, my dollar produced $2 that I could go do something with. So you can already probably understand my frustration. It's why wasn't I putting in $71,954 into this policy a year? Because then what would my cash value increase be this year? It would be $148,020. Or why didn't I put in $719,540 in it? Because my cash value increase this year would have been $1,482,000. Now, the reason I didn't do that, one, I didn't know it. Two, I didn't have enough money to do it, right? I couldn't do it. But if I did, you think I would? Wouldn't you? Of course you would. So this is like, to me, the visual of what you're sharing, Joey, is just talking about how can our dollar do two jobs? How can we put it into an account that's safe, protected from creditors, protected from taxes, does have growth, but its whole purpose is to not stop the compounding on our money. And so I really love this whole tool of creating this opportunity fund, creating an account that, yes, it serves as my emergency fund. And we have plenty of clients who've been doing this, and some of them are having to tap into those funds right now as a means to help them, fill in some of the gaps since the coronavirus is taking place. Some of them are obviously looking at these dollars as a great opportunity fund to start buying investments to be able to do other things, because, man, things are on sale all over the place. But I do want to jump in because we had some questions, Joey, and I want to answer one of these real quickly. One of the questions came in and was revolving around the differences between what we're talking about, which is a whole life policy, which is where the insurance company takes on 100% of the risk. They give us a guaranteed rate of return, and that return grows every year. So our cash value has to grow to equal the death benefit at our age 121. So it gets better. And the question was, could you use a different type of permanent life insurance, which is a type of universal life insurance? And there's variations of this. And the one that was asked about was an index universal life policy. So I want to quickly just touch on the differences of those, because I think it's important to know how these two are different and what is it, and how would that play into using the infinite banking concept. So I can speak to this because I used to own universal life insurance. In 2004 through 2009, I owned variable universal life insurance. Variable universal life is where you would actually invest in the stock market, and you would buy permanent life insurance for some of the protection measures, but ultimately you were trying to get your return in the stock market. And you can imagine how good that worked out for me in late 2008. And that's why I opened my eyes to kind of some of this concept. And index universal life is just a spin on that. They've taken out the full on, you have to invest 100% of it in the stock market to will trust some sort of index. And if the index goes up, you'll get a percentage of it. If the index goes down, you'll just get a 0% credit. The biggest difference between whole life and index universal life, or any type of universal life, is the risk is on the individual versus the insurance company. And when we're talking about our safest cash, right, where we're going to park our car, where we're going to store our cash before we go and invest it, do you want to subject your cash to any form of risk at all?
No.
And for most of us, it's no, right? I mean, the risk we're going to take is inside of things that we can control, usually businesses or investments that we get involved in that we are a partner or participant in. And so our cash, we want to have as many guarantees as possible. So the bigger difference here is the insurance component within a universal life policy is not guaranteed. it's actually term insurance, and it gets more expensive every year. The investment that you're putting it in is subject to the market, right? And hopefully the market always goes up, but it doesn't always go up, right? We're experiencing that this year. And when it doesn't, it seems like getting a 0% credit is helpful, except when you realize that you're a year older, because you now term insurance on that policy has got more expensive that year. But yeah, if you didn't have any revenue, but your expenses went up, what happens to your account value? It goes down. So it's not that those can't lose money. It's that the investment didn't lose money. But again, if right now, if there's lots of businesses out there, namely restaurants and gyms and other things that are considered non-essential or not available to be open, that are bringing in zero revenue, but they have expenses. The expenses keep coming. And so you can see they're losing money. And that's exactly the way a universal life policy works. So for us, we are not looking to try to make our insurance policy an investment. We're actually using it as an alternative to our savings account. And for that purpose, I would not use a universal life policy in this process. Now, if you're looking for it as to be the investment, and you think over a period of time it could be better than the whole life policy, again, that would be something that you could go and do the math, and 40 years from now we could look back and try to determine which one was better. But for what we're trying to do, I want to ensure my money's always growing, and there's never a subject time where insurance could come back to me and say, you owe us more. And, I know we told you that on this piece of paper that it could potentially have this amount of money, but things don't work out quite as well as we wanted to. And we've got to come back and charge you more. And that's the way those policies are set up. But lastly, I'll kind of just go back again to the simple part is when Nelson Nash showed me the biggest and largest owners of these whole life policies were banks. He also would refer to these universal life policies, and he said, now go look at insurance companies' books. They're coming out with these great fancy tools, and I want you to go and look and see how much of their money do they have in these same type of tools. And you would go look on their financial statements, and you couldn't find it. It didn't exist. So the financial institutions were not putting their money, the insurance companies were not putting money in these sort of options that these index universal life policies use. They're putting their money in corporate bonds, into cash flow and real estate, into traditional mortgages. They're putting their money in their own portfolios and not into these speculative assets that they can't back up, because again, they look at their cash as safe too. So I'll get off that horse, but I hope that answered somewhat of your question. It's a good one, and it comes up a lot, but I want to make sure that you understand this is a safe place for our cash, and so we would never want to subject it to potential risk.
Well, and I want to add to what you just said, just a mechanical piece as well. And you can look this up. We actually have some further resources. You can research a lot more detail. But when we're talking about this process of becoming your own banker, or the infinite banking concept, we need a vehicle that is going to help us along that way and not hurt us. So when we're talking about, and I'll just use this picture up here, when we're talking about taking a loan against our policy in a whole life contract, our money is not removed from the vehicle in which it is earning the guaranteed and the dividends and all these sort of things, right? But when in IUL, what happens is that the side fund is the part that is actually paying the interest, which is based on whatever that index is. When we take a loan, money, whatever portion of money that is, it is then removed and put into a loan fund. And that loan fund may have its own specific interest rate that it's being paid, or in many cases it zeroes out, right? So you're losing the growth that was in that side fund, if there is any. Again, we don't have a guarantee because it's based off of index performance. But the last, I mean, just at a high level in my mind, if I want the continuous growth of my money, why would I borrow against it and remove it from the vehicle that is paying the interest? And that's part of again, the high level. It's kind of like, what kind of a vehicle is it built on? What kind of a chassis? And a whole life policy is built on a chassis that empowers and enhances the banking function, whereas the IUL policy, it's just not built for this. And I think people get you kind of focused in on, oh, well, this could have a higher interest rate as a mask to make you miss that. And so anyways, I just wanted to kind of point that out.
All right. So earlier I mentioned, I saw Mark mention in the chat that he had bought an insurance policy from you, and now he's asking you a question, Joey. He said, I put money in there, and I'm expecting my cash value to be a little bit higher than what it is. So I don't know the details of his policy, so I can't really speak to that. I don't know if you can answer
In the
his question.
Q&A here. Okay, I'm in my premium. Sorry, I'm just now catching this. On top of that, my cash value still seems pretty low. When can I expect my cash value to kick up?
Mark, I can just tell you, initially you made a mistake by working with Joey instead of me, but it's okay.
Oh, that's perfect. So Mark, I would have to just look and see if I just have to look and see where it was being allocated. So if it's put into the rider, a large percentage of that should have gone straight to cash. And in some cases, it may not show up immediately. It may not be like the first week or two. It may take 30 days, is generally what we say, is before it to all be, from an accounting perspective, put through there. I'd have to see more specifically what you're talking about, but I'm happy to look at that with you after the fact for sure.
And so here's a good part. Let's talk about this a little bit, Joey. Will you write this out? Because
Sure.
I think one of the things is on policy design and how do these create cash value as maybe opposed to what we've heard, right? So an insurance policy is broken into really two components. There's a component that serves the death benefit, and that's what the insurance company will refer to as the base premium. And so sometimes if you look at illustration, you'll see that there's this thing called a base premium. And then there's this other component that is what we use. It's called a paid up addition, a PUA, and different variations. Every insurance company is referred to that. And all of that is actually paid up insurance. Well, insurance that's paid up has a value. So if I owned an insurance policy on Joey's life for $200,000 and it required no more payments, but yet I would have to wait till he died in order to collect it. Well, you might imagine if I wanted to go sell that to somebody, say, Jim Bob, I know you're in the group. I saw you a second ago making such great comments about how well I've aged. If I were to sell you or give you the option to buy an insurance policy on Joey's life for $200,000, and all you had to do is give me money today, and you knew it was good, he's going to die, how much money would you give me? How much would you give me for a guaranteed $200,000 payout? With the only question is when, right? So you're probably pondering the thought, Joey's health issue, and you may give me a higher number than some others. I'm teasing, but
hey, Russ,
there is a number. There's a time value.
I can hear you right now, Russ. Like,
there's a time value of money. You're just going to do a calculation, right? How much? What interest rate do I want to give you? And yeah, you said less than 200,000. That's right. And we don't know what that number is. Maybe it's 50,000. Maybe it's 75,000. Maybe it's 35,000. There's a calculation you're going to do, and it's speculated based upon how long do we think it's going to take before we get our money back. Well, that's all a paid up additions rider is literally it's paid up insurance, meaning that at your death, this insurance is going to pay out just like the policy on Joey. But today, it actually has cash value. I could sell that for cash, just like I could sell Joey or sell Jim Bob a policy I owned on your life. And so what we try to do is that we take as much of the cash as we possibly can, and there's limits. And I won't go into all those details today, but there's limits to how much money we can put into insurance policies, keep it tax-free. So typically speaking, somewhere between 50 to 60% of the money, or 50 to 70% of the money will go toward the paid up additions rider. And so if I was putting in, a dollar, then, I would typically have 50, 70% of the money would go there, and somewhere between 30 to 50% would go to the base premium. Now, there are conversations out there where people are like, well, why don't I put 90% of the money toward the paid up additions rider? Wouldn't that make better sense? And initially it would look really pretty. Over time, though, that would start to deteriorate, and it would start to take away from our capital. Remember just showing you the example I showed you a second ago, where I had that policy 10 years ago. I was putting in 25,000, but I put so much money in it early on that I could only put in 71.95, and now I'm only able to get 71.95's growth. Where if I'd set it up differently, maybe I was getting growth off 10,000 or 20,000 of that dollar. So you can see where my brain would start to work on. I want a long-term. This is not all about just the here and now. It's about the long-term growth of this. How am I going to use this for my whole life? I want to make sure I have capital. But when we set these policies up this way, the money that goes to that paid up additions rider, as Joey said, typically speaking, about 90 to 95% of that will show up in cash value. So let's just use a number. Everybody can do math off 10,000. So if we put 7,000 of our 10,000 to the paid up additions rider, we're going to have 90 to 95% of that available to us to use as a loan in year one. Typically in year one, out of the other 3,000 I would put in toward the base premium, I would usually have 0 to 15% of that would be available for me to have. So again, there's a reason why people talk bad about whole life insurance, because when 99% of the life insurance agents out there, if you bought a whole life policy, how much of the money do you think they would put in the base premium versus the paid up additions rider?
100%.
Very little, if any.
Yeah.
And Joey, you actually have real life experience in that, right?
Yep. Yeah. Before I met you, I had bought a whole life policy. Honestly, didn't even realize that that's what I bought. And it was.
You had 10% of your money going to a paid up additions rider and 90% going to the base premium.
Yep. It was a complete opposite of what I would have wanted. Yeah.
Yeah. So,
but I was solving for death benefit at the time, Russ. Like that's what I was focused in on. And I thought, that's what insurance is for, right? Just for death benefit.
So anyway, to answer Mark's question, if you put 10,000 into the paid up additions rider, if it was allocated correctly, and that's probably what I would want to make sure the insurance company didn't mess that up for some reason, that 10,000 should have 90 to 95% of that should have showed up in cash value. Now the rest of the money, if it went to the base premium, that money wouldn't have showed up. And I don't know if that was what your question was. Let's jump into more questions that we have here.
Yeah. So, okay. So this one's from Nathan. At what point do you recommend starting multiple policies, cash flow availability, transfer from another savings source? How would you say that, Russ?
Yeah. So the part that is, again, going back through our steps, step one is get our cash flow. And then when we have cash flow, then we're going to start new policies because that's the first place we're going to allocate our dollars. And assuming those dollars are going to keep coming, right? If it's a one-time event, then we really have to be able to evaluate where would we be able to fund the policy, because these insurance policies are an annual thing. Whether we're putting it in monthly or annually, we're going to be putting money in there. So as long as I have excess cash flow coming in, and right now I have 20 policies, and once I could finally get this policy on Joey, we're having to do some legal documents for our business. I'll have 21 policies. So as you can tell, I've been doing this over 10 years, and I keep buying policies. Actually, I found the best way to get concierge medicine. You guys know what concierge medicine is. It's when you go to a physician and you don't have to worry about insurance and all that stuff, and you can walk right in, you can see the doc. I've even expedited that process. I've got it to where they come to me. I don't wait. They wait in my waiting room, actually. They wait in my waiting room to see me, to give me to do my exam. And if you want to know what that is, I buy an insurance policy all my life every single year, and they come and do an exam on me, and then I get all the lab work, and thankfully it continues to be excellent, as you guys can tell, and I don't have to go and see a doctor, and it's a wonderful thing.
So, but the point he was adding was, make sure that you have the cash flow. When you have increasing cash flows, it's always a good time to start thinking about another policy and making sure it's sustainable, right? The second thing I would say is that you have other opportunities that will come along that will create. So sometimes it's a windfall. Sometimes it is like right now, we have a lot of people taking advantage of various things. And I'm going to I'm going to answer Curtis your question along with this. But so the SBA loans that are being thrown out right now are ridiculous terms. They're 30-year terms with 4% max interest rates, and they're really kind of loose right now as far as what people are willing or how they're able to get them. And so there are people that are taking those funding policies and then looking at opportunities to get a much higher rate of return within their business or outside of their business. Maybe it's starting a land flipping business or Amazon or whatever it might be, or buying even turnkey rentals for that matter, and then utilizing that cash flow to repay the loans. So a lot of people also are using 401k withdrawals, and that's because they now have access to them and they don't have the 10% penalty. They still have to pay tax on it, but they're going to pay tax on it now or they're going to pay tax on it later. The big deal has always been the 10% penalty. And so, anyways, long story short, windfalls are a good opportunity to to put in new policies. When you have new lives, like kids, grandkids, Nelson used to always essentially meet the parents of his grandkids or great grandkids at the hospital and have them sign off on applications for starting a new policy on their kids, because we're not guaranteed insurability. And Nelson learned that from one of his daughters who had a serious health issue. And so he wanted to make sure that he could always insure their lives. So I don't know if that answers the question fully, but hopefully
Yeah,
it
no,
helped.
it's whenever we have access to cash, in concert of what we're trying to do, step 1 through 4 is having a place to put it first, and then finding the best place to invest it. And that kind of comes into William's question: is this better than a 401k? And the answer is you know is a life insurance a better asset to save cash to deploy it into an investment than the wrapper of a 401k, right? Because most people, when they say 401k, and I'm just going, I don't know what you're asking perfectly, but since I've been asked this a lot of times people think of the 401k as an investment, meaning that they think, you'll hear people talking, hey, my 401k earned 20% last year, or, it earned 50% last year, or lately it lost 30%. But really what they're referring to is the investments internally inside the 401k. The 401k is literally just a tax code. It's the way that you can invest. It's the wrapper. So like the life insurance policy would be the equivalent to the 401k, meaning it's just the name, it's the title. Where was it invested, is where we're coming from. So if the question is, if we're going to invest dollars, would we invest dollars from an account that's going to grow every year, that we're going to have access to it, it's not going to be subject to taxes, not going to be subject to creditors? Or would we invest it from an account that would be subject to taxes in the future, would be subject to losses in the future, and wouldn't be accessible to us until 59 and a half, barring some hardship like we're dealing with today? So I would say from that perspective, the place of which we can access the money for sure is going to be much better. So the life insurance policy. Now, as far as the investment is concerned, if the things that you're investing in your 401k, like maybe it's mutual funds, sometimes if you have solo 401ks, you might be able to actually go out and invest in real estate or some other type of business entity or something, then those two investments I can invest, and I do invest in lots of things after borrowing money from my life insurance policy. And really it comes back to, then we could get the same return in the investment. Where would I want those dollars to come back to? A place that I could access and wouldn't be subject to future taxation, or the opposite? And so I would say from that perspective, if we're looking at the housing of it, I would prefer a savings account like a life insurance policy over the 401k from that perspective, because the investment, ultimately speaking, we should be able to invest in the same things. Only difference would be maybe a 401k is going to limit you, because if you're doing it inside of a company, you probably have a set of funds, 10, 20 funds you can invest in, where obviously I can invest in anything I want to. Or if I take the money as a loan from the insurance company.
Yeah, and also I think to your point, Russ, it's more about where do you line up in the overall plan for your financial freedom. A 401k inherently requires you to put off financial freedom until at least you have access to that money, which in most cases is 59 and a half or beyond. That may be great with you. You may be like, man, that's exactly what I want to do. And other people, they want to take control of their finances today, and they want to utilize those dollars to get there faster. And so a whole life policy is going to give you access and be able to give you no limits on what you can invest in, whereas the 401k requires you limited options. You have to defer the taxes in many cases, and there's not to mention high fees, and the time frame is dictated to you rather than to it. And
Right.
so
So
those are
Joe,
those are thoughts that I have.
we got a question from Caesar. He says, "Can you explain the long-term growth problem with the 1090 split? I'd read that 1090 split would provide the highest cash value in low interest rate environment, which looks like we will be in for a while." So again, this is going back to the example we were talking about a second ago. The reference is 10% of the money going to the base premium. So scroll up, Joey, just so that way we're reminding people what we're talking about. 10% of the money going to the base premium and 90% of money going to the paid up additions rider. And again, just if you look at the example I gave, if 70% of the money went to the paid up rider, we said there'd be $7,000 of cash. Versus 90% went to it, we would have $9,000 of cash. So that'd be very appealing today. And I totally understand why people want to go in that direction because of that. It's sometimes what we need is it gets overwhelmed by what we want. So a couple of things I would say in this. One, from a long-term perspective. So there's a couple of viewpoints, and if you listen to the IBC community on this, there's a lot of discussion on it. One is what are we trying to accomplish? Are we trying to create an account that we're going to grow our cash in and we're going to deploy it into investment opportunities that are going to create passive income streams? We're going to have this long-term mindset of how long are we going to put in money, and our capital has to reside somewhere, and we never want to be afraid of putting money in. Just like going back to my policy, I can only put in $71.95 in today, but it grew by 2 times that number. And so clearly, I wish that number was not $71.95. I wish it was 71,000 or 719,000. Right? All of those numbers, I wish it was much bigger. So therein lies the biggest problem in the 1090 is that the way these insurance policies are set up, they have so many little riders, and I won't bore everybody who doesn't know enough about this right now, but there's so many little riders that are added into these that ultimately speaking, at some time, if we do stay in a low interest rate environment, it's actually going to be a hindrance, Caesar, is because the dividends, the way those policies are designed, they're based upon the dividends that are being paid every year being great enough to pay for the term insurance that it's associated for those policies not to become a taxable event. That term's called a modified endowment contract. And so if that dividend is not great enough to pay for it, they're going to have to reduce how much money they can put in there. And they're going to be subject to potentially that dividend not being big enough, then it can actually cause that policy in the future to become a modified endowment contract. So what's going to happen as time goes on, they're actually going to be limited, just like I was in the policy I created 10 years ago, to putting in a lesser amount of money. And the part of the contract that actually produces the largest return is not the paid up additions rider. It does in the first couple of years, but the biggest part, I showed you that policy a second ago. I put in $71.95. I have 0 paid up additions rider on it, but it grew by 14,800. That was 100% the base premium that did that, not the paid up additions rider. The paid up additions rider will show up about 90 to 95% of the cash value. But that paid up additions rider is not going to produce a 2-to-1 effect in the future. So as you can see, there's a benefit. We're playing a fine line there to where we're trying to create cash early on, but not at the spiting ourselves and cutting off our nose for the future. And so I really I understand why people ask questions about these and why this is a hot topic, because it seems exciting. I get more of my money faster, but also we got to know that we're playing a life game here, and
Right.
if we're growing capital, if we're really going to do step 3 and 4 really well in our process, and we're going to buy assets and produce cash flow, we're going to have a place to put money in the future. And we're not going to want to be limited, because I can promise you right now, I put in a lot more money in the life insurance policies than I ever expected to do. And I hope in 10 and 20 and 30 years from now, I'm doing 3 or 5, 10 times more than I'm doing today. I don't ever want, like, if our example from the very beginning was, do you want to put it in a savings account or do you want to put it in a life insurance policy? And the answer was, I want to put it in a life insurance policy because of all of these reasons. But if I get into the future, and in the future, I'm not guaranteed my health, right? I know Jim Bobby said I'm aging well. I thank you for that. Thank you, because some of that's from your great advice and giving me tips on things. Well, in the future, though, I may not age as well. I may actually become uninsurable. Or because of the way I set up these policies, I actually may get too high of a death benefit and I may not be able to get more insurance. So then I got all this money and I really wish I could put it in the insurance policy, but because I set it up this unfortunate way, and the way it's set up forced me to put less and less in every single year at some point in the future. Now I'm putting in 10 times, 20 times, 100 times more money into that one account that I didn't want to put it in, that savings account. So you could see why that would be a really bad thing.
Right.
So I don't know if that answered your question. That could be an hour and a half discussion just in of itself, but those are just some real high points there.
So we have another question here. Before we get to that, I know we're over time, so I want to make sure there's a very clear step here. If this is something that you have been researching and you say, okay, I need to get with a coach to help me with this, our group is available for that. And I want to just make sure people know how to do that before we get off the call today. Within the app, I just want to point this out really quick. You can actually go right up here to the top left corner where it says schedule a call with us. When you click that, you'll have access to get into our calendar and work with one of our coaches. So I want to make sure people know that this is the step to get your opportunity fund off the ground. And you do not have to know every single detail that's possible. That's why you work with the coaches that you do, that you feel confident that they know what they need to know to help guide you along the way. Just like buying a car, I'm never going to know every single thing about that car before I step into it and, turn on the key and go. I have to trust that there's certain components of that are going to work on my behalf. So I want to make sure people know that.
Joey, that really quickly though, you're showing the version that's online, and in the app it doesn't have that button. So make sure you tell people that, because most of us are using the actual app, the Wealth Without Wall Street app. I hope you are, at least. So how do they set up a time to ask those questions there?
So within there, you're actually gonna have.
This is where I just stumped him. I just got him. This is the point where Joey's face starts getting red, guys. Just watch him. He doesn't know what to say here. He's trying to figure it out.
I have to pull it up.
It's getting red.
App. Come on.
It's getting so red right now. All right,
Russ. What do you say?
This is where I defer Thomas and Ern. By the way, I know where it is, but I don't know if there's an easier way. Way I would do it is I would go to courses. So click on courses, Joey.
Got it.
I'd go to courses. I'd go to IBC 101, which is the course that they would be taking there, right? And then the last step in that process, you actually have on the wrap up and next steps, you have Ernie, who is one of our coaches. It gives you a call to action in there that will allow you to do it. So if you're in the app, that's the way I would do it. If you're doing this from your desktop computer, then you could go to that little call to action. So anyway, I'm glad that you did that. That was funny. I really enjoyed it.
I thought there was something else that I was maybe missing, because of course I knew where that was, you punk.
All right. So the last question, Ashok asked, and I hope I pronounced your name correctly, said, which of these companies do you like better? One America, Ohio National, Penn Mutual, others? The answer is yes. So Ashok, I actually own policies with all three of those companies and three others as well. our criteria for picking companies is that first and foremost is that they must be a mutual company, meaning that the owners of the company are the policy holders. They're not a stock company. So if you can go online and see a stock symbol for the insurance company, that would be called a stock company, and we would not want to do business with them because we want the profits to come back to us. I love it when I hear people say, man, the only reason those insurance companies are in business is to make profits for themselves. And I go, absolutely they are. I really appreciate you saying that. And as an owner of the company, I hope we make tons of profits. And that's a really wonderful thing. But if you own if you're in a stock company, then you would not be getting those profits. Those profits would be going to stockholders. Another big aspect is that we don't want to convince insurance companies that this is an idea that they should be behind. Some insurance companies really don't like the fact that we take the amount of loans that we do. And even though it's a contractual privilege that is in the policy that they created, and we're literally only using the policy and the contract language that they have to do it, they actually try to disincentivize both the people, their agents that do business with them, and their customers. And so we don't like those companies. We tend to stay away from those. Pretty much the rest of them all fall into a very similar column. They have 100 years of history. Obviously, they have strong financials. They give us access to the cash value in the first year, typically the first week, first month. All of those are big features we're looking for. We tend to, work with companies that are going to meet all this criteria. And also the last one that we would look at is make sure they've paid a dividend every single year they've been in existence. And there's probably 6 or 7 that we tend to work with in a given year. There's probably 10 or 11 that exist out there that we would, but just for simplicity, once you find 1 or 2 or 3 that you really, that fits your criteria, we will just work with them throughout the year. And then at the end of every year, we tend to reevaluate and see if there's been any changes, anything that's happened. And we actually had that at the end of last year. There was actually some changes that happened out there as the federal government required insurance companies to change the way they calculated their mortality. And that caused some of the companies that we were working with to not look as well, not perform as well for the policies that way we would design them. And so we kind of shifted, and that happens. So again, our job is to do that analysis, be the one that's looking underneath the hood of the companies. And we'll use companies that we personally own policies with because we want to know what's going on. And I think that's the best way to do it. So I hope that answers your question. And thank you, everybody, for being on this call, for going through IBC 101. I know for most of you, it's like, man, how fast can we get to passive income? And a lot of times we want to skip step 1 and 2, but those really are the foundational tools to everything we do. And starting on Thursday, we're going to start diving into passive income options. And I know that you saw in our live event, it said that we only have 4. But just like anything, Joey and I had to overdo it. We had to add a 5th. Oh. So we're actually going to have a 5th one that's going to get added into the schedule next Monday. But this Thursday, Joey, we've got an event. And tell us who's going to be coming up and what will they be learning?
Yeah, so this week it's short-term rentals with Jay Massey. He is a master at implementing this strategy. He's been at it for to be honest with you, I don't know exactly how many years he's been on this specific strategy, but he's done everything from cell phone towers to multifamily to long-term turnkey, fix and flip, wholesale. And he has landed, he said, point blank, hands down, if he had opportunity with Airbnb and short-term rentals from day one, this is the fastest route to truly passive income and financial freedom. And so I'm really excited to continue to learn from him. As you know, Russ, we are actually implementing our first Airbnb in June, and it'll be the condo that I've owned for years and years and never made any cash flow. And so I'm excited to implement this strategy and start making some cash flow on it. So.
Well, and this is a great thing. I saw Jim Bob put a comment in there, as long as everybody's not on quarantine. Like when you are learning from like professionals, or you're learning from people who are doing this, then you find out, Warren Buffett has a saying, when the tides, rising tides rise all boats, but also when the tide goes out, you see who's wearing a swimsuit and who's not. And I love the fact that when we interview people on our podcast, we really get to ask questions of the people that are talking to us. And we learn a lot about those people. We learn, do they really know what they're talking about? And the way we learn is by asking them, how much of this are they doing personally? And Jay Massey has a business in which he brings in over $1 million personally in short-term rental. And I don't know how much money he makes and coaching people up on how to do this. But when I talked to him right as this COVID virus started, and I started asking him questions like, tell me, like, I just assumed that all of his rentals were just dead empty, right? I mean, nobody's
Yeah, just
traveling. He's
empty.
all his rentals are actually in California. The majority of all his customers are coming from Asia to California to do business. Well, those business trips have been canceled. Those flights have been canceled. And so I was just like, well, Jay, what are you doing, man? How are you making out during this time frame? He said, Russ, the demand is still there. Now, it's not our Asian traveler that we used to have. Now the demand is coming from the front lines. It's these first responders, it's these nurses and doctors, it's people that are exposed to the virus and need a place to go, but they don't want to go home. And so the challenge is that we're having to try to be able to let them know we exist because they need a place to go. It's these families that are unfortunately going through divorces right now, and they're being told, well, stay put right now. We can't deal with all of this, and so spouses are having to live together, and they don't want to live together, and so they're looking for a place to go. So this is someone who is doing it and is actively figuring out how to manage all circumstances. Obviously, like everybody, he's dealing with cancellations, but I just love the fact that we're going to get to learn from an expert. And next week is going to be no different. We're going to get to hear from 3 other experts. So if you are interested in creating a passive income stream, which is hopefully why you're here, it's a process to get to financial freedom, then Thursday is going to be another great one. And look forward to having you on. And thank you for taking the time with us today. Hope you have a wonderful day.